Between 1985 and 1991, Japan deployed $77 billion buying Rockefeller Center, Pebble Beach, and Hollywood studios. Within 5 years, they'd lost half of it. We're looking at all 7 stages of history's largest leveraged buyout failure. Picture the closing, October 1989, Rockefeller Center sale documents. Mitsubishi estate wires $846 million, a substantial premium over market valuations. The CFO believes they're acquiring the crown jewel of Manhattan real estate at a 6% yield. What he doesn't see, the Federal Reserve is about to raise rates, the Bank of Japan will be forced to follow, and the yen-dollar exchange rate is about to make his 8% projected return mathematically impossible. 6 years later, they'll hand the keys to creditors without recovering a single dollar of equity. The question isn't whether vendor financing always ends in forced liquidation. It's whether anyone notices the currency mismatch before the margin call. This is stage 1, overextension. Here's why this matters to you. If your pension fund invested in Japanese growth mutual funds in the late 1980s, you bought into the largest asset bubble in modern history at the absolute peak. The Nikkei hit 38,915 in December 1989. That's $4 trillion in market cap that would lose 80% of its value over the next 3 years and wouldn't recover for 35 years. Now here's the boardroom reality. Japan was running an $80 billion trade surplus annually. Every Toyota, every Sony television sold in America generated dollars that had to go somewhere. The first option, buy U.S. treasuries. Safe, liquid, but earning maybe 7 to 8% while the yen was appreciating 15% per year. Do that math, you're losing 7 to 8% annually in real terms after currency adjustment. The second option, bring the dollars home and convert to yen. But that accelerates yen appreciation, destroying your export competitiveness. I've just created the problem you're trying to solve. Japanese finance ministers face what dealmakers call trapped capital. You're generating returns you can't reinvest without destroying your business model. The Americans are running massive deficits. The Germans are worried about reunification costs. And suddenly, Japanese capital is the only bid with scale. U.S. sellers see this, a desperate buyer with $80 billion burning a hole in their pocket, and a 24-month window before currency appreciation makes everything unaffordable. Enter the Plaza Accord, September 1985. G7 finance ministers meet at New York's Plaza Hotel and agree to orderly appreciation of non-dollar currencies. Translation, we're going to force Japan to strengthen the yen to reduce the U.S. trade deficit. Over the next 3 years, the yen goes from 240 to 120 per dollar, a 50% revaluation that doubles the yen cost of every dollar asset overnight. This creates the vendor financing trap. Japan needs Americans to keep buying Toyotas, which means Americans need dollars, which means Japan needs to recycle those dollars back into U.S. assets. But now there's a countdown. Acquire dollar assets now, before the next 50% revaluation makes everything twice as expensive. The entire Japanese institutional complex, banks, insurance companies, pension funds, trading houses, shifts into panic deployment mode. Here's what this means for you. If you owned commercial real estate in Manhattan, Los Angeles, or Honolulu in 1986 to 1987, Japanese buyers just offered you 30 to 40% more than any American would pay. If you were trying to buy property in those markets, you just got priced out by a tsunami of capital with a 24-month shot clock. American sellers aren't stupid. They see the desperation. Rockefeller Center is valued conservatively by American standards. Mitsubishi pays $846 million. Pebble Beach is worth maybe $500 to $600 million based on golf course cash flows. Japanese buyers pay $841 million. Columbia Pictures might be worth $2.5 billion. Sony pays $3.4 billion plus $1.2 billion in assumed debt. Every single transaction includes a 20 to 40% "please take my dollars" before they're worth half as much premium. You might be thinking, but these are trophy assets. Rockefeller Center, Pebble Beach, Hollywood studios. Isn't there inherent value in owning American landmarks? Doesn't prestige justify a premium? Here's the problem with that assumption. Prestige doesn't pay debt service. Mitsubishi financed Rockefeller Center with yen-denominated debt at 5 to 6% interest rates. The property generates dollar rents with a 4% cap rate on the inflated purchase price. Now add currency risk. If the yen strengthens another 20%, those dollar cash flows are worth 20% less in yen terms. Your 4% yield just became 3.2%, and you're paying 5 to 6% to your lenders. The math doesn't work, and it never worked. The CFO signed the deal knowing the returns were negative after currency adjustment. That's not prestige. That's desperation with a 24-month countdown. Britain 1919 to 1925 faced the identical trap. Sterling overvalued after World War I, forcing British capital into dollar assets before inevitable devaluation. When Britain returned to gold standard at pre-war parity in 1925, the overvalued pound destroyed export competitiveness and forced a decade of deflation, the exact mechanism Japan would trigger 60 years later. And that's just stage 1, the trap being set. Stage 2 is where they walk into it at full speed. This is stage 2, trophy acquisition. Here's the personal stake. If you worked in real estate, finance, or construction in Los Angeles, Manhattan, or Honolulu between 1987 and 1989, your commission checks tripled because Japanese buyers were paying cash at 40% premiums and closing in 30 days. If you were a regular buyer, you were competing against institutional capital with orders to deploy $20 to $30 billion annually, regardless of price. The boardroom directive from Tokyo was explicit: acquire hard assets in dollar-denominated markets before the next yen revaluation makes everything unaffordable. Not acquire good deals. Not acquire at reasonable valuations. Acquire, period. The Ministry of Finance provided administrative guidance, soft enforcement suggesting which sectors to target. The main banks provided covenant-light financing at 2 to 3% interest rates with minimal due diligence. Picture the Mitsubishi Estate boardroom, July 1989. The CFO is presenting the Rockefeller Center acquisition. The deal math shows an 8% unlevered return. Decent, but nothing special. Then someone asks about currency risk. The CFO says, we hedge by assuming the yen stabilizes at current levels. Translation, we're making a one-way bet that the currency intervention stops exactly here, and if we're wrong, the entire return disappears. The board approves it anyway. Why? Because every other keiretsu is doing the same thing. Sumitomo is buying Pebble Beach. Sony is buying Columbia Pictures. Daiichi is buying trophy office buildings across Manhattan. If Mitsubishi doesn't deploy capital, they signal weakness to their main bank relationships and cross-shareholders. This is where the cross-shareholding lock-in becomes a trap. In U.S. public companies, activist shareholders would kill these deals immediately. The returns don't justify the risk. But Japanese corporations have cross-shareholding arrangements where banks, insurers, and industrial partners own each other's shares with implicit no-sell agreements. There's no hostile takeover threat, no activist pressure, no mark-to-market accountability. Management can pursue deals that destroy shareholder value as long as they maintain relationship capital with their main bank. The main banks love this. They're earning 2 to 3% on massive loan volumes with minimal credit analysis. The collateral is Manhattan real estate. What could go wrong? They're booking record profits in 1988 to 1989 because loan growth is exploding and underwater exposure recognition is zero. The Ministry of Finance is happy because deployed capital means yen demand decreases, giving them more time before the next plaza-style intervention. Here's why this matters to you. Japanese institutions bought $77 billion in U.S. real estate between 1985 and 1990. That's $16.5 billion per year, representing a dominant share of commercial transactions in gateway cities. This isn't niche behavior. This is systemic repricing. Manhattan office rents surged sharply. Los Angeles luxury home prices soared. If you were a teacher, firefighter, or nurse trying to buy your first home in these markets, you just got locked out for a generation. American investment banks saw the opportunity and structured it into maximum fees. Goldman, Morgan Stanley, and Salomon Brothers earned substantial advisory fees facilitating these transactions. They'd find a motivated seller, inflate the valuation with a comparable sales analysis, cherry-picking peak transactions. Then introduce the Japanese buyer who had orders to deploy capital regardless of price. The bank collects 2 to 3% on both sides, and nobody has accountability when the deals blow up 5 years later. You might be thinking, but weren't these sophisticated institutions? Didn't Mitsubishi have teams of analysts running the numbers? How could they not see the currency risk? Here's the problem. They did see it. Analysis at the time reportedly showed that a 20% yen appreciation would destroy returns. The deals got approved anyway because of what dealmakers call organizational momentum. When everyone in your peer group is doing the same thing, the career risk of being the one firm that sits out is higher than the financial risk of losing money alongside everyone else. On the CFO, who blocks the Rockefeller Center deal and then watches Sony successfully acquire Columbia Pictures, has just ended his career, even if Rockefeller Center would have been a disaster. That's not analysis failure, it's incentive failure. Britain, 1924 to 1929, saw identical capital misallocation. The City of London deployed substantial capital into American stocks and German bonds at bubble valuations, believing sterling strength proved economic superiority. By 1931, half of it was worthless. The overvalued currency wasn't a sign of strength. It was the mechanism that made everything they bought too expensive. That was the deployment. Stage 3 is where the currency repricing makes all of it underwater in 24 months. This is Stage 3, hidden repricing. Here's your personal stake. If you're a Japanese salaryman who bought stocks or real estate in 1989, believing lifetime employment and rising asset prices were permanent features of the economic model, you're about to watch 60% of your net worth disappear in 36 months, and it won't recover in your lifetime. The boardroom trigger is simple. The Federal Reserve starts raising interest rates in 1988 because U.S. inflation is accelerating. Fed funds go from 6.5% to 9.75% over 18 months. This does two things simultaneously. First, higher U.S. rates mean dollar assets become more attractive, which strengthens the dollar against the yen, the opposite of what Plaza Accord intended. Second, higher rates mean lower asset valuations. Bonds and real estate both reprice downward when discount rates rise. And now the Bank of Japan faces what central bankers call impossible trinity. You cannot simultaneously have fixed exchange rates, free capital flows, and independent monetary policy. Pick 2. Japan wants currency stability to protect exporters and free capital flows to deploy the trade surplus. That means they've lost control of interest rates. They have to match whatever the Fed does or watch capital flee to higher U.S. yields. December 1989. Bank of Japan raises rates from 2.5% to 3.75%. May 1990. Another hike to 5.25%. August 1990. 6%. This is catastrophic for every actor in the system simultaneously. For Japanese banks, they've lent trillions in yen at 2 to 3% interest rates against collateral, stocks and real estate, that was valued at bubble prices. Now rates are 6%, which means new lending costs have doubled. But the existing loan book is locked in at 2 to 3%. Their net interest margin is collapsing. Worse, the Nikkei peaks at 38,915 in December 1989 and crashes to 23,000 by August 1990, a 40% decline in 8 months. Land prices start falling for the first time in 40 years. The collateral backing their loan book just lost 20 to 40% of its value, but regulatory forbearance means they don't have to mark it down yet. For Japanese corporations with dollar assets, the properties they bought in 1988 to 1989 are generating the same dollar cash flows, but now those dollars are worth less in yen terms as the yen strengthens. And the yen-denominated debt service costs just doubled from 3% to 6%. A property that was supposed to generate 8% returns in yen terms is now generating negative 5% after currency adjustment and higher financing costs. Mitsubishi's Rockefeller Center is suddenly substantially underwater, and it's only been 12 months since closing. Here's what this means for you. If you're a Japanese household, your savings account rate goes from 2% to 0.5% because banks can't afford to pay depositors when their loan book is imploding. Your stock portfolio crashes 60%, your home value enters a 20-year decline, and your company starts quietly breaking the lifetime employment promise by moving workers to window seats, positions with no responsibilities, waiting for early retirement. The currency mismatch creates a one-way trap. Japanese sellers can't exit dollar assets without converting back to yen at loss-making exchange rates. If Mitsubishi tries to sell Rockefeller Center in 1991 for $700 million, recovering most of the dollar purchase price, they have to convert at 125 yen per dollar, which equals 87.5 billion yen. But they paid 101 billion yen at 120 yen per dollar. They've lost 13.5 billion yen even though the property only declined 15% in dollar terms. The currency moved against them harder than the asset value. You might be thinking, But couldn't they just hold the assets long-term and wait for recovery? Real estate always comes back eventually, right? Here's the urgent rebuttal. That logic works if you have patient capital and no forced sellers. But Japanese banks are facing a covenant breach. When your loan book is collateralized by stocks and real estate that have lost 40 to 60% of their value, regulators require you to raise new capital or reduce lending. The banks can't raise capital. Who wants to invest in an insolvent bank? So they have to force borrowers to deleverage. That means calling loans, demanding collateral top-ups, or forcing asset sales. Mitsubishi doesn't get to wait it out. Their main bank is telling them to sell or inject fresh equity. That's why holding periods don't matter when you've got a margin call. Britain 1929 to 1931 faced the identical forced repricing. The pound was overvalued after returning to gold standard. German reparations dried up, and suddenly the 400 million pounds in continental bonds turned into underwater exposures. Britain tried to defend the peg with rate hikes, which triggered domestic deflation, which made the debt burden worse. They abandoned gold in September 1931, and the pound fell 30% in weeks. The deflationary spiral lasted a decade. Now we have to address the elephant in the room, the single point of failure, the cross-shareholding system. If Japanese banks had marked their loan books to market in 1990 to 1991, the entire banking system would have been insolvent, forcing a Sweden-style nationalization and restructuring. Instead, regulators allowed forbearance, which delayed recognition, but let underwater exposures compound for a decade. By 2001, Japanese banks had 150 trillion yen in problem loans, 30% of GDP, triple what an early restructuring would have cost. The mechanism that saved the banks in 1991 created the lost decades. The repricing is locked in. Stage 4 is where the forced liquidation begins. This is Stage 4, forced liquidation. Here's the household impact. If you work in real estate, finance, or construction in Japan, your lifetime employment guarantee just broke. By 1995, Japanese banks are quietly moving tens of thousands of workers to subsidiaries, offering early retirement packages, or assigning them to Madogiwazoku roles, window seat tribe positions with no work while they wait for pension eligibility. The boardroom reality, Japanese banks are now sitting on what will eventually be recognized as 150 trillion yen in underwater exposures. But in 1990 to 1992, regulatory forbearance lets them pretend the problem is temporary. The mechanism, banks classify underwater loans as Category 2, requires monitoring instead of Category 4, which requires write-off. This lets them avoid raising capital, but it means they're now zombie institutions, neither dead nor alive, unable to lend but unwilling to restructure. Picture the Mitsubishi Estate Emergency Board meeting, October 1995. Rockefeller Center's cash flows are covering only 60% of debt service. The main bank, Bank of Tokyo Mitsubishi, is demanding either inject 30 billion yen in fresh equity or hand over the keys. Mitsubishi doesn't have 30 billion yen of liquid capital to inject. Their stock price is down 70% from peak. Issuing equity would be catastrophically dilutive, and doing so would signal to the market that all their overseas acquisitions are similarly underwater. They choose option 2. Rockefeller Center goes to a special purpose vehicle controlled by creditors. Mitsubishi loses 100% of their equity, roughly $846 million, without recovering a dollar. This becomes the template. Pebble Beach sold in 1992 at a loss. Columbia Pictures written down by $2.7 billion. Hawaiian resorts liquidated through the mid-1990s. The liquidation cascade works like this. One forced sale establishes a new comparable transaction price point. If Mitsubishi dumps Rockefeller Center at 50 cents on the dollar, that becomes the comp for every other Japanese-owned Manhattan tower. Sumitomo looks at their buildings and realizes they're now marked at phantom values. Their main bank starts asking questions. The auditors start requiring reserves. Within 24 months, every major Japanese institution with U.S. real estate is either selling or writing down. But here's the problem. Who's buying? American institutions see Japanese forced sellers and wait for maximum distress. Why pay 70 cents on the dollar in 1993 when you can pay 50 cents in 1995? The market knows these are motivated sellers with collapsing balance sheets and limited time. Every sale happens at incrementally worse pricing because buyers have perfect information about the seller's desperation. Here's what this means for you. If your pension fund or 401k had Japan exposure through the early 1990s, you watched a safe, developed market allocation lose 60% in dollar terms and stay underwater for 15 plus years. The Nikkei wouldn't return to 20,000 until 2015, a 25-year round trip to half the peak value. Meanwhile, the S&P 500 quadrupled from 1990 to 2000. The opportunity cost of staying in Japanese equities was 800 plus percentage points of foregone returns. The real wealth destruction happens in Japanese households. Land prices fall 87% from peak to trough over 20 years. If you bought a Tokyo home in 1989 with a 30-year mortgage, you're still underwater in 2010. Your mortgage payment is the same, but the collateral is worth 1/7 of what you paid. You can't move because selling means crystallizing catastrophic losses. You can't refinance because the loan-to-value ratio is 600%. And you can't default due to social stigma and lifetime credit damage. You're trapped in a house worth 30 million yen with a 200 million yen mortgage. You might be thinking, but didn't the Bank of Japan cut rates to zero? Doesn't unlimited liquidity solve the problem by giving banks time to grow out of the losses? Here's the problem. Zero rates only work if borrowers want to borrow. All Japanese corporations looked at their balance sheets in 1995 and saw debt-to-equity ratios at 200 to 300%, collateral values down 60%, and deflationary expectations making future revenues worth less than current revenues. Their rational response was to repay debt, not borrow more. This creates what economists call a balance sheet recession. Even with free money, the private sector runs a financial surplus. The Bank of Japan can make credit available, but they can't make anyone take it. That's why the liquidity subsidy runs from 1999 to 2016 without creating inflation or growth. Britain, 1931 to 1935, executed identical forced liquidations. British banks sold American railroad bonds, utilities, and real estate at 40 to 60% losses to meet liquidity requirements after abandoning gold. The sales were orderly but devastating. Total losses represented a significant percentage of British GDP. The liquidation took 5 years and British capital never returned to pre-crash allocations. The liquidation is complete. Stage 5 is where the permanent scarring becomes visible. 30 years and counting. This is Stage 5, permanent scarring, and we're still in it. Here's your personal stake. If you're a Japanese household today, your net worth is roughly the same in real terms as it was in 1990. 35 years of zero wealth accumulation despite working, saving, and following every rule. Your government's debt went from 60% of GDP to 260%. Your savings account has paid 0% interest for 25 years. This is what unresolved balance sheet recessions look like at the generational level. The boardroom reality. Japanese corporations shifted from growth to survival. The mechanism is the balance sheet recession framework. When debt-to-equity ratios hit 200 to 300% and collateral values collapse, corporate priority shifts from profit maximization to debt minimization. Firms generate cash flow and use it to pay down debt instead of investing in expansion, even when interest rates are zero. The data is staggering. From 1998 to 2012, the Japanese private sector, households plus corporations, ran a cumulative financial surplus of 1,500 trillion yen. Translation, they saved more than they invested for 15 straight years. The government tried to offset this by running massive deficits, 1,000 plus trillion yen in fiscal stimulus. It wasn't enough. GDP growth averaged 0.8% annually for 15 years. Here's why policy couldn't fix it. The Bank of Japan cut rates to zero in 1999, then went negative to negative 0.1% by 2016. They bought 500 plus trillion yen in government bonds, ETFs, and REITs. None of it created inflation or growth because the transmission mechanism was broken. Banks had capital, but corporations didn't want to borrow. Households had savings, but deflation made cash more valuable than consumption. The demographic trap made everything worse. Japan's working-age population peaked in 1995 and has declined every year since. Fewer workers means less consumption, less tax revenue, and higher social security burdens. The debt spiral becomes unavoidable. Government borrows to fund deficits, which increases debt service, which requires more borrowing. Here's what this means globally. Japan proved that central banks cannot cure balance sheet recessions with monetary policy alone. You can make money free, but you can't make people borrow it. This matters because the United States, Europe, and China are all running similar playbooks now. Encourage asset bubbles, let private debt explode, then try to solve the bust with zero rates and quantitative easing. Japan is the 35-year case study showing it doesn't work. The cultural scarring is permanent. Japanese households who lived through the 1990s crash have the lowest risk tolerance in the developed world. They hold 55% of financial assets in cash, despite zero returns. They don't trust equities, don't trust real estate, and don't trust government promises. This creates a doom loop. Risk aversion prevents capital formation, on end which prevents productivity growth, which validates the risk aversion. Britain 1935 to 1950 entered identical structural stagnation. The balance sheet damage from 1931 liquidation, combined with World War II debt, created 15 years of sub 2% growth, despite full employment and Marshall Plan aid. British household wealth stagnated for a generation. The pound lost reserve currency status. The pattern: once balance sheet recessions embed, policy becomes irrelevant. And that's the 7-stage pattern. The final question: is vendor financing always doomed to forced liquidation, or just when the acquirer makes a one-way currency bet with covenant-light leverage? The pattern is clear. Vendor financing always ends in forced repricing. You accumulate assets in the currency your customers use, finance them in the currency you earn. Once in prey, the exchange rate never moves against you. It always does. Japan deployed $77 billion and lost half. Britain did the same with sterling in the 1920s. China is doing it now with Belt and Road loans in dollars, while holding $3 trillion in reserves. The 7 stages don't change, just the names and the timeline. The question isn't whether the margin call comes, it's whether anyone notices the currency mismatch before stage 4.